Welcome to Iron Financial. This is the place you come to forge a stronger portfolio and to cut right through all that market weakness. Today, we are firing up the forge. We're putting on the safety glasses because we're doing a full structural analysis of a nuclear energy behemoth, Cameco. Now, this company is supposed to be at the white-hot center of the global energy transition. But on its biggest day, the market got cold feet. So we're here to do the heavy lifting. We're going to stress test the fundamentals and figure out if this company is built from solid steel or if it's about to buckle under pressure. There is a huge disconnect between performance and price here, and we are going to hammer it out. Okay, let's get into it.
Yeah, let's just cut right to the chase here. On the very same day that Cameco reports a massive, blowout fourth quarter earnings report, one that should have sent the stock straight to the moon, it drops. It drops over 3%. And let's be crystal clear about this. They didn't just beat their earnings per share estimates. They beat them by more than 50%. They didn't just top their revenue expectations, they absolutely crushed them. And Wall Street's reaction to this? The big money, the institutions, the trading algorithms, they all slammed the sell button, and they slammed it hard. That is a massive disconnect. You know, it's the kind of paradox that just screams one of two things. Either it's a giant red flag telling you to run for the hills, or it's a glaring buy signal that the market has just completely misunderstood. So really, my only question today is this. What in the world is the market seeing that we aren't? Or is the market just dead wrong? And that right there, that is the central question. And that's exactly the framework for our entire analysis today. We're going to hammer this thing out piece by piece, following a very clear blueprint. First, we're going to dig into this earnings paradox in detail, just laying out the raw numbers. Second, we'll go deep into the financials and see exactly how they're forging these record profits for the full year. Third, we are going to analyze the new engine that they've bolted onto their chassis, the Westinghouse acquisition. Fourth, we'll zoom out and look at the macro picture, the powerful bull market tailwinds that are lifting this entire sector. Fifth, you're going to get your chance to play devil's advocate and point out any potential cracks in the armor. And finally, after we've weighed all the evidence, we will deliver the Iron Financial verdict. All right, let's get to work. All right, let's lay out the crime scene, because that's really what this feels like. So February 13th, Cameco reports its Q4 2025 numbers. Earnings per share, they come in hot at 50 cents. Now, the consensus on the street, the number that all the big banks had plugged into their fancy models, was a mere 32 cents. That is a 56% beat. In any normal, rational market, that alone is a catalyst for a major rally. But it gets better. You look at the top line, the revenue. They reported $1.2 billion for the quarter. The street was expecting $765 million. That is not a beat. That is an absolute obliteration of expectations. So by every conventional metric, by every single textbook rule of investing, this stock should have gapped up at the open and just soared. Instead, it fizzled out and closed the day down 3.33%. This isn't just some small wobble. It's a direct, screaming contradiction to the fundamental data, and it absolutely demands a real explanation. Exactly. And to find that explanation, we have to do what most of the market simply fails to do. We've got to ignore the short-term market noise, tune out the knee-jerk algorithms, the daily chatter, and just get our hands dirty with the raw materials. Look, a stock price can lie for a day, a week, maybe even a month, but a full-year income statement and a balance sheet, they tell the truth. We need to analyze the structural integrity of the company's full year 2025 results. This is where the real work begins. So let's start building this analysis from the ground up, starting with the foundation, the annual results. Let's see what this thing is really made of. Okay, so let's start with the top line. What's really interesting here is the sheer scale and the momentum that we're seeing. We're looking at total revenue of nearly $3.5 billion for the full year 2025. This isn't some stagnant, mature business coasting along. This represents an 11% increase from the $3.14 billion they posted back in 2024. Now, in a capital-intensive industry like this one, that kind of top-line growth is the very first sign of health. And this growth is being fueled by two critical factors: higher realized prices for the uranium they sell and a really robust performance from their fuel services segment. So this isn't a one-trick pony. This is the first pillar of our analysis. It's the bedrock of the entire structure. And believe me, it is solid steel. And this is where it gets really powerful. We follow that strong revenue right down the income statement to pure profit. Net earnings attributable to equity holders, $590 million. Now listen closely to this comparison. In 2024, that same number was $172 million. That is a more than threefold increase. It's a 243% jump
year over year. This isn't just growth. This is an absolute explosion of profitability. This is what we call operating leverage, and it is a beautiful thing to see in action. It means that as revenue takes up, a much, much larger percentage of it is falling directly to the bottom line. As prices and demand rise, the profits aren't just inching up, they are literally rocketing higher. So the crucial point is, the business is becoming exponentially more profitable. This is the engine, and it is firing beautifully. And this right here, this just brilliantly illustrates the core operational strength. Adjusted EBITDA. We look at this metric because it strips out some of that accounting noise, things like depreciation and amortization, which are huge in a mining business. And it gives us a really clean look at the raw cash-generating power of the business. It hit $1.93 billion for the year. For comparison, that's up significantly from $1.53 billion the prior year. This shows that the cash-generating engine at the very heart of the company is not just running, it's accelerating. This isn't financial engineering or some one-time accounting gain. This is the direct result of producing and selling a valuable, in-demand commodity in a rising market and doing it efficiently. Okay, now just look at this table. This is the financial fortress they have built over the last 12 months. Let's just walk the wall. Revenue? Up. We covered that. Now look at gross profit. Up from $783 million to $970 million. That means their core operations are becoming more profitable even before you factor in overhead. Net earnings. We just saw that massive 243% jump. But here's the one that really matters to me. Cash from operations. It saw a significant increase from $905 million to $1.41 billion. Cash is king, right? It's the lifeblood. You cannot fake cash flow. Looking at this, it is a solid wall of green. Every single key metric is showing robust, multifaceted improvement. This isn't a company with a single trick. It's demonstrating comprehensive financial strength across the board. This is what a fundamentally sound operation looks like on paper.
Okay, fine. I will concede this. The foundation looks solid. You can't argue with the balance sheet. It is a fortress. They're ending the year with $1.2 billion in cash and short-term investments just sitting in the bank, and that's against only $1 billion in total debt. They are net cash positive. This gives them immense flexibility, a real war chest. They can weather storms, they can pounce on opportunities, and they aren't beholden to their creditors. From a pure financial health perspective, this is a picture of strength. I'll give you that. But a strong foundation is just the price of admission. It doesn't explain why I should get excited. What's the growth story? Where's the next billion in revenue supposed to come from?
That is the perfect transition, because you are absolutely right. A solid foundation is one thing, but if you want to build a skyscraper, you need a powerful engine for growth. And Cameco isn't just a uranium miner anymore. That's the old story. The new story is that they have bolted on a new high-performance growth engine with their 49% acquisition of Westinghouse. This isn't just some little add-on. It fundamentally changes the company's entire structure. It integrates them deeper into the nuclear fuel cycle, from reactor services all the way to fuel fabrication. This is where the long-term growth story gets incredibly compelling. This is the next chapter.
And this isn't some theoretical pie-in-the-sky future growth we're talking about. The Westinghouse investment is already on the books, it's already delivering, and it is outperforming their own internal acquisition case expectations. Just look at the numbers. Westinghouse's adjusted EBITDA was up a staggering 30% in 2025. That is phenomenal growth for an established industrial giant. They were a key subcontractor for the Dukovany nuclear project in the Czech Republic, a project that added about $170 million to Cameco's share of revenue in a single quarter. This is the new Cameco. It's not just about digging uranium out of the ground in Saskatchewan anymore. It's about servicing reactors in Europe, fabricating fuel for a global fleet, and participating in the entire high-margin, long-term life cycle of nuclear power. Now, this changes the entire scale of the conversation. This takes it to a whole other level. Cameco, through its stake in Westinghouse, has entered into a strategic partnership with the U.S. government. And the explicit goal? To accelerate the deployment of Westinghouse AP1000 and AP300 reactors. And the number attached to this partnership is a staggering $80 billion. Just let that sink in for a second. This isn't a small grant or some little pilot program. This is a nation-state level commitment backed by the full faith and credit of the U.S. government to build out new critical nuclear capacity using their technology. This provides a clear decades-long runway for growth that is almost unparalleled in the energy sector. It transforms the company from a commodity producer subject to price swings into a key partner in building out critical global infrastructure. This is a total game changer. Okay, that's a powerful story. I get it. Westinghouse is a beast. But you're starting to sound a little bit like company management.
My job is to ask the hard questions. Is this strength really unique to Cameco, or are they just a ship being lifted by a tidal wave? Because if the whole sector is booming, that's a different kind of investment entirely. It means we have to understand the forces at play in the entire ocean, not just the quality of this one particular ship. An individual company can look great, but if that macro environment shifts, if that tide goes out, that beautiful new growth engine can stall out fast. So how durable is this nuclear bull market really? Is this real, or is it just the latest Wall Street hype cycle? I'll let the CEO, Tim Gitzel, answer that directly, and then I'll break down exactly why he's right. He calls it a durable trend of growth. The key word there is durable, not temporary, not cyclical. And look at the three structural pillars he names: electrification, energy security, and decarbonization. These aren't fads. The rise of AI data centers, the global push for EVs, this is creating an unprecedented, voracious demand for 24/7 baseload electricity. Second, geopolitical instability has made energy independence a top national security priority for every serious country in the world. And third, the push for carbon-free energy is a multi-decade global imperative, backed by trillions of dollars. Nuclear power sits at the dead center of the intersection of all three of these unstoppable megatrends. This isn't a cyclical upturn. It is a fundamental, structural shift in how the world generates power. And this chart brilliantly illustrates the core thesis for the entire industry. This is the uranium supply gap. It's the single most important chart for understanding this entire space. The blue bars represent projected, locked-in demand from the world's nuclear reactors. The orange represents projected supply from all known and planned mines. And that massive white space between them? That is the deficit. That's the problem the world has to solve. UXC, a leading market researcher, estimates that the cumulative uncovered uranium requirement is about 3.1 billion pounds through 2045. At COP30, 33 countries signed a declaration to triple their nuclear energy capacity by 2050. The demand is politically mandated and physically locked in. The supply is not. It takes 10 to 15 years just to permit and build a new mine. It is the most basic economic principle in the world. You've got exploding demand meeting constrained supply. This creates a powerful, long-term, structural tailwind for the price of uranium and for the producers, like Cameco, who are in the driver's seat. Okay, you've built a fortress. I hear you. Record profits, a rock-solid balance sheet, a new growth engine in Westinghouse, and a massive structural tailwind for the entire industry. I've heard the bull case loud and clear, and it is compelling. But if everything is so perfect, if the foundation is so incredibly strong, we have to go back to my original question. Why did the stock sell off on the best news it has had in years? A structure can look perfect from a distance, but the market often has a magnifying glass, and it focuses on the hairline cracks. So now, it's time we put this armor under the microscope. Let's find those cracks.
And here it is, laid out side by side. On the left, you've got the fortress, the bull case we just spent the last 10 minutes building. It's strong. But on the right, you have the market's nagging concerns, the ghosts in the machine. And the first one is memory. The market has a very long and very unforgiving memory for disappointment, and the ghost of the third quarter of 2025 is still rattling its chains down the halls of every single trading desk. Investors got burned just one quarter ago on a massive miss, and that kind of trust is easily broken and really, really hard to win back. That memory is still fresh.
Let's break these down because they are not trivial. First, that Q3 miss wasn't just some small stumble. They reported earnings of just 7 cents per share when forecasts were for 23 cents. That's a huge miss that completely broke the narrative of flawless execution, and it really shook investor confidence. Second, let's look forward. Their guidance for 2026 production is a range between 19.5 and 21.5 million pounds. Well, in 2025, they produced 21 million pounds. So at the midpoint of their own forecast, their guidance is for a slight decrease in production. In a booming bull market with uranium prices soaring, the very last thing investors want to hear is that you're planning to produce less of it. It just raises questions about operational issues. And finally, let's not forget the context. The stock was up 146% in the 12 months leading up to this report. After a parabolic run-up like that, some investors will take any excuse, a slight miss on guidance, a bad memory from Q3, to hit the sell button and lock in those massive profits. That creates selling pressure that has absolutely nothing to do with the long-term fundamentals. These are the cracks that the market is seeing. All right, the arguments are on the table. We've seen the forged steel of the bull case, the financials, the Westinghouse engine, the macro tailwind. And we've examined the potential hairline cracks of the bear case, the Q3 memory, the guidance, the profit-taking. Now it's time to bring it all together. It's time to weigh the evidence, to put these two competing narratives on the scale. We need to determine if the market's short-term reaction is a warning sign of a trap for unwary bulls, or if the long-term structural integrity of this company presents a massive opportunity created by that exact fear. It's time for the iron financial verdict. Our process for the verdict is clear and it's methodical. We don't make decisions based on emotion. So step 1, we fully acknowledge the short-term risks that you just laid out. The memory of the Q3 miss and the slightly soft production guidance are real factors influencing traders, and they're creating headwinds. We don't ignore them. Step 2, we weigh those short-term issues against the heavy-duty long-term fundamentals. How much does a single quarter's miss really matter against a threefold increase in annual profits? How does conservative guidance for 1 year stack up against a new $80 billion growth pipeline through Westinghouse and an undeniable macro supply gap? And then step 3, we make a call. We conclude if the market is rationally pricing in genuine long-term danger or if it is emotionally overreacting to surface-level noise and recent memory bias. Our verdict is decisive. This is an opportunity. The market's reaction is a classic case of short-termism. It is focusing on the small, surface-level cracks while completely ignoring the forged steel foundation beneath. The memory of one bad quarter and slightly conservative guidance for a single year are being weighed more heavily than a 243% increase in annual profit, a new $80 billion growth pipeline, and a multi-decade structural deficit in its underlying commodity market. That, in our view, is a profound miscalculation. The fundamental long-term strength here far, far outweighs the short-term jitters. We believe the market sold the news, driven by algorithms and profit takers, creating a pullback that represents a compelling entry point for investors who have the discipline to focus on the long-term structural story. So there you have it. The iron financial verdict is in. We have laid out the bull case and the bear case, the financial fortress and the hairline cracks. We have put the entire structure through a rigorous stress test. The final question, as always, is for you. Do you believe the market's fear is a justified warning, or do you see it as a window of opportunity? Will you follow the short-term herd that's reacting to the noise, or will you trust the long-term fundamentals we have forged here today? The choice and the responsibility is yours. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.